Welcome to the Lifestyles Unlimited Real Estate Investor Radio Show, a real estate investment program. Listen and learn how to use real estate to build wealth and passive income streams for you and your family. We bring you experts every day to discuss and answer your questions on everything from single-family homes all the way up to 600-plus unit apartment complexes. And now, the Lifestyles Unlimited Real Estate Investor Radio Show.
Welcome to the show. My name is Al Gordon, and as always, we're working on your financial freedom. On today's show, I'm going to dispel a myth. Yeah, there's a myth out there, and here's the myth. The myth is this, that everybody that gets started investing in real estate starts with a ton of money. And you know what? That isn't necessarily true. That is, well, from our experience at Lifestyles Unlimited, we shatter that myth. As a matter of fact, the majority of us do not start from a place of wealth. We must build wealth over time. And on today's show, what I will do for you is I will go through some information regarding some of our members that recently presented information at a case study. Now, case study, for those of you that don't know, at Lifestyles Unlimited, we offer an event called Case Study. It's an opportunity for our membership to get together, and it's an opportunity for them to learn from other members that have gone forward before them. And at these case studies, we normally focus on 2 single-family projects, and then we focus on a multifamily project. Well, last week, I focused the Friday show on the single-family products. As a matter of fact, I probably went way too fast for some of you, and I apologize for that. It's just that I wanted to get the information out there. What I wanted to show you is that there are people just like you who have made a difference in their lives. And they started with just one rental property. And over time, they acquired another rental property and another rental property. And what Friday's show was designed to show you is that, well, it showed you a couple of things, to be honest with you. If you didn't hear the show, go to lifestylesunlimited.com, and from there you can click on the radio tab and you can get all of our best of shows, essentially. So what we do is we do these shows and they get packaged up into a podcast, so you can listen to those things at your leisure. But the big takeaway from those shows was this. They were young couples. What do I mean by young? People in their 30s that didn't have a massive amount of wealth to start with. No, they didn't. They had some money put aside. They had been making investments in other areas that weren't providing for them the types of returns that they wanted. They investigated real estate. They found Lifestyles Unlimited. And as they say, as the cliche goes, the rest is history. So we talked about Gavin, who was on his 4th deal. We talked about my good friend Isaac and his wife Carolina. And the key takeaway from that show was that they were able to find investments that when the dust all settled and you looked at the total amount of money that ultimately wound up coming out of their pocket because they were using the techniques and procedures that we teach at Lifestyles Unlimited, their cash out of pocket was very, very low. I think for Gavin, it was something like $1,100. And for Isaac, it was around $5,000. And these produced wonderful properties for them. Now, I will be the first one to tell you that they were home run hits. In other words, we don't always find properties with such low cash out of pocket. But the key thing is this. We do find properties like that. And when we go into an investment, we're not necessarily concerned with, I want to make sure this deal only is $1,000 out of pocket or $5,000 out of pocket or whatever it is. Those are goals and objectives that we might set for ourselves. Now, I will tell you in Gavin's case, I don't think he was focused on getting a deal that would require only $1,100. He just happened to find the right deal. But he's done other deals that have required a little bit more money. Same thing with Isaac and Carolina. Now, their strategy is a little bit different. They focused on properties that would produce a certain amount of cash flow for them. And that was one of their strategies. So the other component that they looked at was they wanted to make sure that they captured enough equity in the deal. So their guidelines are this: the property must produce $100 a month in positive cash flow, and they must be able to obtain $25,000 in equity capture. If the deal doesn't do that, they don't do the deal. But the neat thing is this. They weren't focused on getting into a deal that would only cost them $5,000 out of pocket. They were prepared for a higher injection of money. But in the deal that they presented, they didn't need that higher projection. And as we found out later, one of the things that Isaac disclosed is that the majority of the properties that they find are only costing them $5,000 out of pocket when the dust settled. In both scenarios, in Gavin's scenario and in Isaac's scenario, they had cash flow that went forward, and essentially they spent more money out of their pocket than the end result. So they paid some contractor money up front. They did some other things that cost them money up front. As they went through their hard money process, they were able to get draws on that money. And then when they were able to refinance the property on the back end, they were able to refinance and get cash back, which ultimately lowered their cash out of pocket. It's really, really good news. But on today's show, what I will do for you today is I'm going to focus now on the multifamily space. See, not everybody that comes to Lifestyles Unlimited gets involved with single family. Now, they may have single family on the mind as they're going through their educational process, but when they complete their educational process, what they learn is that maybe multifamily is the way to go. And on today's show, I'm going to talk about Claude and Martha. Now, Claude and Martha have been members of Lifestyles Unlimited for a little over, right at the 3-year mark, as a matter of fact. They're at their 3-year anniversary. And what they did is they went through the educational process, and they decided that multifamily was the way to go. And when we come back, we're going to talk about how they were able to obtain a 109% return in just 20 months.
Del Walmsley explains how he found that speck of light that got him into the lifestyle.
I had a guy that used to come into the health club every day and work out for 4 hours a day, sit in the jacuzzi, swim, play racquetball, was happy, looked great, tan all the time. And one day I just asked him, what do you do for a living? And he said, Del, I own real estate.
Well, do you own real estate? Register for our live online free workshop and find out how you can get all the things you want out of life with passive income. Register at lifestylesunlimitedworkshop.com. Brought to you by Lifestyles Unlimited.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. Now, let's get back to your map to financial freedom.
Welcome back to the show. So what we're going to talk about is a multifamily deal that Claude and Martha put together as members of Lifestyles Unlimited. And I'll tell you what, let me just get right to the point. By doing the things that they were taught, by educating themselves correctly, by surrounding themselves with individuals that are on their team, they were able to acquire a 24-unit apartment community, and that particular property has produced a 109% return in a matter of 20 months. You heard me, 109% in 20 months. So, if you're sitting there thinking about the stock market, and the stock market seems to be doing great, and, yada, 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 keep in mind that historical returns in the stock market don't get you to 109% in 20 months. They just don't. You can look it up. I've looked it up, and I don't see returns like that. Now, there are individual stocks that maybe you could invest in that have the potential to maybe do that. But to do that takes a lot of research. It takes a lot of knowledge, and you still might get burned because you're not in control. See, Martha and Claude are absolutely in control of their investment. They bought it. They rehabilitated the property. They put great residents in the property. They're self-managing the property. They were doing all the things that are necessary to increase the valuation of this property. And let me just point out to you, they're just regular people like you and I. Now, let me give you some background on them. Now, Martha she's well educated. She has a Bachelor of Science in marketing. She has a master's in publicity. So she has a very good business background. As a matter of fact, she spent the last 14 years leading new entrepreneurial startups. Yeah, that's her expertise. So she is a very gifted lady, and she has done some wonderful things with businesses and the operation of a business. So it's kind of nice to have that kind of background coming into the real estate investing. Now, Claude, on the other hand, he is continuing a 30-year career in supply chain management and consulting with power generation and automotive industries. So he has a very deep knowledge of how business systems work because he has worked within those systems for 30 years. And I'll tell you what, it's that kind of background that really helps them to be positioned to be real estate investors because you don't have to reinvent the wheel. You don't. You can take a lot of the knowledge that you have and you can apply that knowledge on how to operate a business because that's exactly what they're doing. They are operating a business. See, multifamily and single family for that matter are essentially businesses. And if you don't approach the operation of that real estate as a business unit, then you may be missing the boat. But at Lifestyles Unlimited, we teach you how to do all of that stuff. So there's not a lot that you have to worry about. Now, just to give you some more background information on Claude and Martha, they're a married couple. They've been married for about 14 years. They have a beautiful 12-year-old daughter. And, they're just like you and me in many aspects. I asked them, why did you join Lifestyles Unlimited? And their original premise for coming on board was they really wanted to explore investing in single-family properties. They had no previous real estate experience, which, can be good because they had no bad habits that we had to change. And, they found us because a coworker suggested that they check out Lifestyles Unlimited. They basically said, go do a case study and become a member, go through the 2-day financial freedom program. You'll learn way more from them than you'll learn from me. That's basically what the coworker said. And once they did that, they determined, based on the amount of money they had available to them, that they would go directly into multifamily properties. And you know what? They made a great decision. So what they did was they went and found a 24-unit apartment community that was in bad shape. It was suffering from bad operations. It was suffering from deferred maintenance. It really had some issues to it. And they were able to acquire this property in October of 2018. So, little over a year after joining and going through all the educational programs that are out there, they were able to acquire this property for $1,020,000 in total. Okay, so dollar per door, you're looking at $42,500. So back then, that was a pretty screaming price for dollar per door. So that, that's one of those things that caught their eye. Now, in order to do this deal, they were going to need $550,000. Now, they didn't have $550,000. So what they did was they partnered with other members of Lifestyles Unlimited and were able to bring 7 other families on board to do this deal. So now they have the capital they need in order to move forward with the investment. The initial financing was at $843,000. They received a 6.25% interest rate at a 6-month interest-only terms. Now, of course, we fast forward to today's rates, and I'll tell you what, that doesn't sound very good. But at the time, that was a very, very good loan considering the condition of the property. And they estimated it was going to take them about $200,000 to do all of the capital repairs. Now, the income on this property is producing $265,000 per year. The expenses are running about $105,000. So that gave them a monthly cash flow of about $8,800. Now, we all know that the value of the property is calculated based on a cap rate applied to the net operating income. So at the net operating income of $160,000, that was taking the income minus the expenses, that left them at a value of $2.1 million. And that was based on a 7.5% cap rate. Now, I, to be honest with you, I think they're a little high on the cap rate. I think they could get that cap rate down a little bit. I think that property now that it's all fixed up and is producing the revenue streams that it's producing, I think they could get a better cap rate. But, we're not talking about selling the property right now. We're just talking about getting a valuation. And at 7.5%, I think that's a very conservative look at what they're doing. So what they're receiving right now, as to date, after doing all the things that they needed to do, they have a cash-on-cash return of about 8.35%. And they've actually distributed cash back to their investors so far, now that they've done all the heavy lifting and made the repairs to the property that they were looking to repair. This property didn't look so great when they acquired it. It really didn't. I'm looking at a before photo, and it's just kind of bland. It's an eyesore. It doesn't pop. There's something that seems to be absolutely missing. Well, except for the shed right square in the center of this property. That's right. The previous owner put a shed right in the middle of the property. It's bad. But when we come back from the break, I'm going to talk about what they did to improve the property. And as a result, we're able to get market rents. Oh, there's a whole lot to go over. Stick around. We'll be right back.
Warning, listening to the Lifestyles Unlimited Real Estate Investor Radio Show will change your life. We will teach you how to create wealth and passive income so you can be financially free. And now, back to your host.
Welcome back to the show. We're discussing an apartment community that two of our Lifestyles Unlimited members, Claude and Martha, took over in 2018. And I'll tell you what, over a 20-month period of time, they have turned something that was not performing very well and really just didn't look very good into the opposite of that. It is a remarkable transition that they have created in this property, and they've done it in, like I said, in 20 months. Just to give you a visual picture of what the property looked like, this is a 24-unit apartment community. It's 2-story. It has pitched roof, and it's in a U shape, meaning that if you're looking at it from the street, you're looking into the U. In the very center of the courtyard was a little, I don't even know what to describe it as. I'll just describe it as they described it in the case study. They said it was a mosquito-infested pond. And you know what? Now that I look at it that way, it does look like a mosquito-infested pond. And right behind this mosquito-infested pond was it looks like a 10 by 12 aluminum storage shed with the back facing the street. And it's got some dents in it. It's just an eyesore. It looks terrible. I mean, this is the focal point of this property as they're taking it over. And it just makes you go, blech. It really does. So one of the things that they did as they went through the rehab process is they got rid of that. They did. They completely transformed that centerpiece into something of beauty. I mean, they were able to incorporate landscaping. They were able to get rid of that shed. And now they have a feature in the center of the property that looks much, much better. On the interiors, that's where a lot of the heavy lifting occurred. See, they went in and they evaluated each of the living units, and they determined what needed to be accomplished in order to increase the value perception of a potential resident. In other words, if you looked at the property in the before pictures, I mean, it doesn't look bad, but it doesn't look good either. You've got carpeting in different rooms. You have some linoleum in the kitchen. The countertops are very dated. Remember, this property was, I believe, was built in 1970. And, it just kind of looks like it was built in 1970 and time has occurred. So what they did is they went in and they completely rehabbed the interiors. I mean, they refaced all the cabinets. They put new countertops in. They put in brand new appliances. The appliances all match. They fit very well with the color scheme. The walls have a nice, basically a two-tone kind of paint feature to them. They got rid of all the carpet. They put in vinyl plank flooring because as we learn at Lifestyles Unlimited, vinyl plank is not as affordable as carpet, but it is much more durable. So therefore, when you make the investment in the vinyl plank, you're making an investment in a product that will last a good period of time, and therefore it reduces any potential costs with flooring when it comes to making turns. What a turn is somebody, eventually decides to move out. Maybe they're going to move somewhere else. Maybe they bought a house, whatever reason they move out. People move out. And so what you have to do is you have to refresh the property to make it appealing. And that's the key word here. They made the interiors of this property very, very appealing. When you look at the before photos, what you see is photos that were probably commanding the rents that they were receiving. We'll get into the rents in a little bit. But when you look at the after, you can understand why they were able to increase the rent rates to market rate. And as a result of that, they're getting better income. Now, let me just give you an observation of the cash flows. They're into the second year of the property. So when they presented the cash flows of the property, when they presented all the numbers, that's what we do at Lifestyles Unlimited. We present all the numbers so that you can understand what's going on. The income in year one. Now remember, during year one, they're getting the property up and running. They're fixing up the property. They're doing all the things they need to do. And in the process, they're also increasing rents. Their rents went from $625 a month at inception when they took over the property. That's what those properties were renting for. And when you looked at the interiors, that kind of gives you an indication of what the interiors looked like. What they're receiving now in rents, now that everything has been fixed up and freshened up and cleaned up, they're able to receive $900 a month in rents for the Save Living spaces. These are all 2-bedroom, 1-bath units. They're all 800 square feet. They're all identical on the interior, and they look so much better. So that when a prospective resident comes to look at the product that's there now, it looks like it's worth the $900,000 amount. Does that kind of sum it up for you? I hope it sums it up for you. Let me run through these numbers there, though, for you. So in year one, their income was $215,000. That's what they were able to achieve, and that included some rent increases on the property. In year two, what they're projecting, and again, the key word is projecting because we're not complete with the second year. It won't close out for them until December 31st. We've got about 2/3 under the belt, but they're projecting rents at $265,000. That includes any income they get from the laundry room, and it's based on the leases that they have in place. So they're very confident they will achieve that target number. Now, their operating expenses, they were paying $130,000 a year in year one. That's what their operating expenses were. In year two, because they've been able to do some things to create some economies of scale, they've been able to do some things with conservation and reducing costs. What they've been able to do and what they're projecting for is a total operating expense of $104,000. So what they've done is they've raised the income, they're reducing the expenses, and I'll tell you what, that shows up loud and clear on the net operating income line. So for year one, their NOI was $85,000 for the year. What they're projecting in year two is $160,000. So they've essentially almost doubled the net operating income. Now the mortgage doesn't change. They still pay a flat fee for the mortgage because, well, that's the way it was. And their net cash flow in year one was $29,000, and it returned a cash on cash return of 5.3%. Then that means the amount of money that was returned to the passive investors in this particular deal. When you look at what they're projecting for year 2, the net cash flow jumps from $29,000 all the way up to $105,000. And what that will allow them to do is pay a cash on cash return of 19.3%. You heard me, 19.3%. And that's just on the cash flow. That is just on the cash flow, that we haven't taken into consideration any increases in value that they've achieved by following the Lifestyles Unlimited model. We haven't taken into account some of the other factors that are present, because we make money 5 different ways in real estate. You've heard me talk about that on the show many times. And I'll tell you what, this is really a great deal, a really, really great deal. So when we come back from the break, what I'm going to do is I'm going to talk about how they've been able to force appreciation in order to capture even more equity. And that's how they're able to get the returns that they're getting. More after this on the Lifestyles Unlimited Real Estate Investor Radio Show.
One of the things I'd like to get across is that your whole life you wanted to make a change, right? But you've never had the time. This might be it, because we have online education that you can get involved in.
We're now going to bring the free workshop to the entire country and really the world. Anybody who is interested can participate in that. We're going to live stream that free workshop and have people online with you on the live stream, talking with you, answering questions, interacting. You're really going to get a great feel for the Lifestyles community from this. And you can register for that. So if you want to find out about us, this is a great way to take a look at us and what we do.
Lifestyles Unlimited has been helping people succeed since 1990. Join us for our free online real estate workshop and learn the 7 principles we teach to run our businesses and provide for our families. Register at lifestylesunlimitedworkshop.com. That's lifestylesunlimitedworkshop.com.
Welcome back to the Lifestyles Unlimited Real Estate Investor Radio Show. It's time to turn up the volume and fine-tune your passive income plan so you can create the lifestyle you've always wanted.
Welcome back to the show. So we're discussing the concept that most real estate investors do not start from a place of wealth, and that they must build that wealth over time. And in the case of Claude and Martha, that's exactly what they're doing. They started real estate investing with some money. Now, I'm not here to tell you they had absolutely no money, because that's not true. They started with money. But for the deal that they found, they really needed to have $550,000 to do the deal. And they didn't have it. So what they did was they partnered with other Lifestyles Unlimited members, and they brought in 7 other families into the deal. And together they were able to get their investments to the cash point needed in order to do this deal. And what I'm going to talk about in the final segment here is just, some of the amazing things that have occurred because they focused on, first of all, finding the right asset. Second of all, doing the things that were necessary to remediate the fact that even though it was the right asset, it was a non-performing asset. This particular property suffered from problems with operations. In other words, it had issues with its tenant base. It had issues with the collections associated with that tenant base. It also had other problems in the form of the property was just, it really didn't look good. It especially on the interiors, it looked very, very dated on the interiors. So what they did was they acquired the property. They put everything into motion that was necessary to remediate that property. And over time, they have remediated 100% of the property. So let's get into some of the numbers, because one of the things you need to understand is the concept of forced appreciation. This is the concept that by increasing revenues, in other words, increasing the income, by controlling the expenses, they were able to increase the net operating income of this property over time. Now, they didn't do it. I mean, this didn't happen in 30 days. That would be unreasonable to expect that. But what they were able to do over a 20-month period is to create forced appreciation. And this is how they did it. At the time of takeover, going back 20 months ago, the net operating income that the property was producing was $48,000 per year. So when you use a cap rate, and a cap rate is essentially a dollar amount that the markets produce, basically saying if you came in and you bought an asset, you paid all cash for it, what would be the return on your money if you were unleveraged, if you paid all cash? And essentially, this particular property, based on the net operating income, the property value when they took it over was $1,020,000. Okay, and to be honest with you, I don't even think the income streams really provided for that value. But for whatever reason, that was the value that was discussed. That was the value that was created. Now, in year one, once they crossed the threshold of year one, what they were able to do was they were able to get net operating income increased. They were able to increase it to $85,000. And it's probably a functionality of starting the process of getting the property cleaned up, helping those residents that weren't paying or were in violation of their lease to move on, and to start attracting good quality residents. So they were able to get the net operating income up to $85,000. Now keep in mind, they had leases in place at lower rental prices that they had to honor. That's law. You must honor a lease. You take over a property, you assume the conditions of the lease. So the property value at the end of year one, and that's using I think they used a 7.5% cap rate. Let me check my numbers here real quick. Divided by 0.075. Yes, that's exactly what they did. They determined that the market would be able to bear a 7.5% cap rate on the property at that particular time. Now, everything wasn't completely finished. There were still things that needed to be done, but they were able to increase the value of the property to $1,133,000. So in other words, they were able to push the equity or force the equity up in the property by $113,000. Now, here's the real good news story. Because what they figured out was, even though it may appear on the surface that they paid more for the property than they should have, what they understood was this, that the rents being charged on that property were extremely low. I mean, they were renting the property for $625 a month on average. And the market rents for cleaned up, fixed up, nice property in that submarket is $900. So by achieving those $900 rent rates, what they're projecting for the end of year two, they're not there yet, but they know they're going to get there because they've done everything they need to do on this property. Everything's been fixed up, and they've got a great resident base in this property. That net operating income is jumping up to $160,000. So if you still stay with that 7.5% cap rate, which I think is a little bit conservative, what they've been able to do is increase the property value to $2.133 million. That's right, $2.133 million. So what they've been able to do is they've been able to push the equity up to $1,133,000. Now remember, they bought the place for $1,020,000. So they have in essence doubled the property value, and they're doing great. They basically calculated it's 109% return in a 20-month period. And we asked them, what do you plan to do with the property? What is your exit strategy? And they said, well, there's actually two things that they're looking at. Number one, the market rates for refinance are pretty good right now. And like I mentioned earlier in the show, they're at a 6.25% interest rate. So it would be very attractive for them to refinance the property. But here's the other thing that happened. They've already received 3 offers to purchase on this property. That's right. 3 offers to purchase, and they haven't even put the property on the market. It's just based on the fact that they have brokers that understand what they have accomplished in this particular property, and they know that there are investors out there that would like to have that opportunity to own and operate that property, especially since all the hard work has been done. So they've got a good problem. What do you do? What do you do? So they're going to analyze the offers they've received. They're going to analyze the refinance. They're going to get with their partners in the deal, and they will make an informed decision. But the key thing is this. Over time, they were able to build wealth, and not only for themselves, but for the people that invested with them. And I'll just give you a breakdown of how they achieved it. This is their list of things that they did in order to accomplish the goals. First of all, they built a great team. They realized that they could not do the things that needed to be done by themselves. They were working on their business, not in their business. And because they weren't working in their business, they needed quality people that could do those components of the business model. The big thing was bringing the rent prices up to market prices, and they did it rather quickly. I mean, when you go from $625 to $900, you're doing great things. They actively participated in Lifestyles Unlimited events and took advantage of attending road trips and other events offered in their education package. And I'll be honest with you, they were very clear. They said they followed the roadmap to a T. They didn't deviate from anything that we taught. And I'll tell you what, by not deviating, by staying focused on the fundamentals that we teach, they were able to achieve great success. They asked a lot of questions. They listened. They executed. And they didn't do deferred maintenance. They fixed everything. They basically said if it looked like it was going to break or need replacement in the next 5 years, they went ahead and fixed it. And, as a testament to them, I would say this. They said their biggest success was overcoming their own fears and trusting in the Lifestyles Unlimited roadmap. Claude, Martha, you've done a great thing. You've created a wonderful property. You've created an excellent place for our residents to live, I should say your residents, and you're doing the things that we taught you at Lifestyles Unlimited. So for those of you that would like to get started with what we do, go to lifestylesunlimited.com and get yourself signed up for one of our upcoming workshops. And remember, it's not the money, it's the lifestyle.
Thank you for listening to the Lifestyles Unlimited Real Estate Investor Radio Show. Ready for more of the map? Visit lifestylesunlimited.com. Explore our videos and articles. Click on the radio tab to access past show podcasts. View the radio show schedule and listen to our best of radio shows. Want to continue the conversation? Follow Lifestyles Unlimited on Facebook today. Join us next time. And until then, remember, it's not the money, it's the lifestyle.
The information and opinions you hear on the Lifestyles Unlimited Real Estate Investor Radio Show are those of the hosts, guests, and callers and do not necessarily reflect the opinions of this station, its affiliates, its management, or advertisers. The Lifestyles Unlimited Real Estate Investor Radio Show is for entertainment purposes only. Please consult a professional regarding your personal investment needs. Nothing presented on the Lifestyles Unlimited Real Estate Investor Radio Show constitutes an endorsement, recommendation, offer, or solicitation to buy or sell any product or security.